Good morning, good afternoon, and good evening from, or rather depending on when and where this finds you. And I trust you're all doing good. Splendid. Thanks for asking. So today we're going to hop on to our part 2 of what makes the market move. And let's straight dive into the heart of the matter. Now, just a brief recap of whatever we learned during the last video. We learned about the number one reason why the market moves, and we said that the market moves to target sell stops and buy stops in the form of buy side liquidity and sell side liquidity, and it takes them out to target the next possible level that is near. Okay, so I believe it was insightful, and at least you gleaned something or learned one or two. Now today let's straight delve into the second reason why the market moves, and today we are going to have a look at what we call the imbalances and the inefficiency in the form of a fair value gap. So number one, we'll start by trying to probably come up with an anatomy, or rather creating an anatomy of a fair value gap. And let's suppose this is our bullish candle. That's our bullish candle one. That's our bullish candle one. And that's our another bullish candle. That's another bullish candle. And finally, this is another bullish candle. Now, in a case whereby in a bullish market, let's have an example of these three bullish candles. If we look at this candle's high, let's assume this. Let's lock it. Let's assume this is our bullish candle, and this is the opening price, and this here over here is our closing price. So this is what I mean. This here is our opening price, this closing price, this opening price, this closing price. This marks our opening price and this closing price. Now from there, what you do, for you to locate a fair value gap, you have to first of all start by identifying three candlesticks, a pattern of three, and they should probably be in this order. So what we do is that we are going to mark the closing price of this first candlestick. This is the closing price, and equally the opening price of this next candlestick. That. Now you see, in between these candles, in between the closing price of this candlestick and the opening price of this bullish candlestick, we have something like a void, or rather a space, for lack of a better word. Now this space over here, the difference between this bullish candles closing price and this bullish candles opening price, this is what we term as the fair value gap. That's our fair value gap, and it's an imbalance. So in our case, we'll add a text. We'll add a text. That's our fair value gap, and our fair value gap is in the form. Our fair value gap is in the form of I think, allow me use a rectangle. allow me use a rectangle. Now this closing price to this opening price, I'll have to change the color. I'll have to change the color. Let's do this. Yes. So now this is our fair value gap. Text. Let's make it. That's our fair value gap in the form of BC. This is our fair value gap, which is in the form of a BC. BC meaning buy side imbalance, sell side inefficiency. It means price was delivered on the buy side. If we carefully look at the high of this candle and it's not the high, or rather the closing price of this candle, this bullish candle, and the opening price of this bullish candle, we'll see that the price delivery was bullish, and it was delivered in one candlestick, which is a bullish candlestick, and we had no bearish candle passing through this void, or rather this gap over here. Now the market's algorithm treats this as a gap, and later on in time it will come back. It comes back and to reprise into this inefficiency, and at times fill it up, and it's not a must. At times it doesn't fill the gap to the pip, and just digging slightly into it is quite permissible, and it's counted as reacting as a reaction point to price. So, and as such, this is our fair value gap in the form of a BC. It was delivered in the buy side, and it lacks a sell side delivery. Okay, now that's as simple as I can put it as far as the fair value gap is concerned, as far as the BC, buy side imbalance, fair value gap is concerned. Let's do the opposite of this, which is our CB. The opposite of this is CB. We have that's our first bearish candlestick. This is our second bearish candlestick, and finally this is that third one. That's that third one. That's that third one. Now, from how we've identified this, we simply transpose this into this other side. This over here, this is the opening price of our bearish candlestick, and this is the closing price of our bearish candlestick. This forms equally our opening price, closing price, opening price, closing price, because this is a bearish candlestick, and we all know, it's common knowledge that in a bearish candlestick the closing price is below the opening price. So we'll start by first of all identifying the closing price of this candlestick, besides the candlestick to the right of this middle candlestick, and the candlestick to the left of this one, this bearish candlestick. We annotate, or rather mark, the opening price of this and the closing price of this. So this is what I'm talking about. this is the opening price and this is the closing price of this. Now we'll change the color. Let's change the color a bit so that it comes friendly to the eye. Border. Yes. Now this space over here between these two candlesticks, between the closing price and opening price of these two, the closing price of this and the opening price of this. Now this, friends, forms our fair value gap. It forms our fair value gap in the form of CB, sorry. That's our fair value gap, and it's in the form of a CB. Now this is the knowledge behind all this. Price was delivered only on the sell side, and as such it lacked a buy side delivery. We have no bullish candlestick passing through the closing price of this candlestick and the opening price of this candlestick. So this forms our fair value gap in the form of a CB, sell side imbalance, buy side inefficiency. We had an imbalance towards the sell side and an inefficiency in the part of the buy side. We had no bullish candlestick passing over the closing price of this candle and the opening price of this candle. And I believe that formed a foundation as far as imbalance and inefficiency is concerned. So let's hop onto our charts and have a lifetime example. I'll get rid of that. Now never mind the time frame. Whatever we do on this higher time frame, like I mentioned before, it's replicated into the lower time frame. The market is fractal, they say. Now if we look over here, this is a pound dollar chart, and this is from 1971. Some of us by that time, I think we were not there, we were not around by that time. Now if we look over here, friends, this is quite a ginormous move. This over here, this move. Now let's spot our fair value gap. First of all, this candle is in the middle. Now we have to train our eyes to look at immediately the candle before it to the left and the candle after it to the right. And we find that immediately to the right, to the left, of this Marubozu candle. For those who are quite familiar with the candlestick patterns, this is a bearish Marubozu candlestick. So we annotate the opening price of this candlestick and the closing price of this candlestick. There we go. Now that, friends, is our CB, our fair value gap in the form of a CB, sell side imbalance and buy side inefficiency. I think I'll have to adjust the color. I'll make it a bit friendly. Yes. Now if we extend this in time, let's extend this in time. If we extend this in time, we see, like I mentioned before, the delivery was solely on the sell side, and as such it lacked a buy side delivery. You see this, it lacked a buy side delivery, so the market had to reprice higher. Remember the last video we talked about the sell side liquidity. Now after this sell side over here was taken, this over here, after this was taken, the market repriced to our fair value gap in the form of a CB. So let me annotate it. So this is our CB. It's our fair value gap and it's in the form of a CB. That's our fair value gap in the form of a CB. So the market had to, after taking out the sell stops here, the market had to reprice back into this fair value gap because it acted as a draw on liquidity. It had to reprice back so as to form what we call, what ICT terms as the balanced price range. So as you can see, it was not failed to the pip or in its entirety. It was never failed, so long as it just hits it, or rather digs slightly into it, into that fair value gap. When price digs slightly into that fair value gap, that's a permissible price action. And okay, also here we have a fair value gap. We have a fair value gap over here that price never revisited. We also have one over here. We have one over there. That's a fair value gap. We also have one over here. We have one over there, and we also have a fair value gap. We have one over there. We equally have one over here. That's our fair value gap. This is our fair value gap in the form of a CB. There is another one over here. We have another one over here. We have another one over here. So I believe we are all now familiar on how to spot a fair value gap, and it can be in the form of a CB or BC. There's also one over here. Yes, we have one over there. If we extend this in time, look at what happened. It revisited this and repriced a bit, repriced lower. Okay, we also have one over here. We have one over here. See how you see what happened? It revisited it, it repriced, the market repriced slightly past it and went up. There are so many friends. We also have one over here. We have this. Why is this thing always misbehaving? I fail to understand why it always gives up on me. Yes, we have one over there. Yes, thank you. Aha. And we have one over here in the form of a BC. This is our fair value gap in the form of a BC. Buy side imbalance, sell side inefficiency. Look at what happened. And remember the very first video, this is an example of an institution order flow entry drill. When a fair value gap is formed and the very next candle digs in slightly into this fair value gap without necessarily getting into the midpoint. This is the midpoint of this fair value gap known as consequent encroachment is here. This is called institutional entry flow, institutional order flow entry drill. When we have a partial dig into a fair value gap and price reprices away almost immediately. That's a fair value gap in the form of a BC. We also have one over here. There are so many. We also have one over here. I don't know why this thing keeps on misbehaving on me. I fail to understand why. We have one over there. We have this. We have this. We have this BC. This is our fair value gap in the form of a BC, buy side imbalance, sell side inefficiency. This is our CB, fair value gap in the form of a CB, sell side imbalance, buy side inefficiency. We also have another CB over here. See what happened? If we extend this in time, see what happened, how price reacted. See how price reacted. This fair value gap acted as a classic support and resistance, for those who are familiar with the support and resistance. So over here we have another BC, buy side imbalance, sell side inefficiency. We also have another one here as well, buy side imbalance, sell side inefficiency. And friends, there are so many. It's all about training your eyes to spot them. When you train your eyes to spot them, then it will probably become second to nature, and you will spot them effortlessly. We also have another CB over there. That's a CB. There's a small one over here. We also have this. This is our CB. There are so many. So many. We have a CB over here. That's a CB. This is a BC. That's a BC over there. Now, I hope that was insightful as far as understanding the fair value gap in the form of a BC or CB is concerned. And I hope you found this insightful. And until we talk again next time, I wish you good time and good trading. Cheers.